Welcome to the weekly update where I'll go over the action in the market for the week of January 27th through the 31st. And we'll see how things look for the week of February 3rd through the 7th. Had a down week for the S&P. Looked like we were going to have a nice strong finish. Probably not a positive week, but we were up 0.53% on Thursday, and then we ended up being down 0.5% on Friday. There's some concerns about the tariffs that are being implemented, and instead of avoiding that or some kind of a deal being struck, the market took that about halfway through Friday's session. We were going up nicely. We hit overhead resistance and we turned and came down and ended up closing negative on the day. We're seeing some concerns with our daily charts, especially with the smart money indicators that are starting to come down. We're still looking positive, though, when you base things around the trend, the short, intermediate, and long term. We're still looking okay here on the weekly charts, but we want to keep an eye on things to see if there's a shift to things being more negative. We're coming into February, which is not one of the stronger months, even though we're in a bigger window of a period of solid returns for the S&P 500. February is the weakest of those better months. So, especially also the first half of February tends to be okay, where it's the second half of February where sometimes we can see some weakness. But there are some changes now with the new administration and lots of things happening. And it's really been difficult to keep up with all those things. So the market's feeling a little bit overwhelmed. But for the most part, they seem to like what's going on. It's not that the tariffs are a new thing. It's up until about 100 years ago when we had the Federal Reserve Act and the income tax enacted back in 1913. That's when we shifted from the federal government getting most of their money from tariffs to getting money from people within the country by taxing their income. And of course, when they first started that, it said, no, only for the rich people. And this isn't going to last very long. We're just going to do this for a little while because we're having some trouble. We had a very difficult time back in 1907, 1908. And just to avoid that kind of a problem again, we're going to enact these new rules. Well, as what is often the case with the government, they come in with something new that's supposed to be only applicable to a certain group of people that usually you would think could afford it. And it's not supposed to last very long, and it ends up applying to everybody and never goes away. So, okay, before I get into the heart of the video, I want to go through some notes. I don't have it on here, but I do have a program where I have courses where I teach about the stock market. I teach about technical analysis. I teach different strategies that may be of interest to you. I also have a class on mental analysis. And if you're interested in that, please feel free to check out the link below the video. But it's the daily videos where I do the real foundation of my analysis. I do a lot of weekly videos and even supplemental videos that I put on the website, but it's really the daily videos. Everything points into that as far as how I evaluate things day by day. I don't forecast. I don't say, okay, we're going down from here, we're going up from there. All I do is look at things day by day by day and say, okay, based on the actual information that we have in front of us, this is what it's looking like. The probability is that we'll go up or that we'll go down or that we'll go sideways. On both the daily side and the weekly side right now, we're not trending. And that's why we're seeing a real choppy market that's really lacking conviction. There's also something to be said, and I'll show you through the charts here, that are we making a double top here? Because we came up to the high that was set in early December, and we came up kind of close to that level, but we've been not been able to get above that level. And that's just one thing that we're kind of watching for. And I go through these things in the daily videos. So if you have the time, I know my videos are longer and I go through a lot of charts. But if you want to get a good grasp as to what's going on, the daily videos are really where that's at. Also, because I'm an educator, that's really my whole approach with this thing is I want to teach you things. I just don't want to tell you things. I want to give you information that you can use and then internalize. And one very small little tool that you might find helpful is I make a PDF of all the slides, and they include the notes that you see here on the screen and the charts that I use in each individual video. And then I post that with each video. Another thing that can be very helpful are a thing called pivot points. And there are pivot points. We have new ones now for the month of February, and those will last for the whole month. And what I do on the YouTube community tab is every day I post a daily chart with the different types of pivot points that apply for the whole month. And then I also post an additional chart for the pivot points that will apply for that particular day. And we went right up to a pivot point on Friday, and that's where we stopped. We started to decline. We came right down to another pivot point, and that's where we stopped. So these can be very helpful, and they're usually quite accurate and give us a good guide for what's happening intraday with price action. I do have a private Facebook group. There's another thing that I just started launching. It's a daily newsletter, and I also have a weekly newsletter. It's available on the website. It's free for right now. It'll end up being $8 a month. And then every day I go through and do a rundown on the major points of what's happening in the market, mainly from a technical analysis perspective. And then I do a weekly video too. Well, if you belong to the Facebook group, you have access to that. So it's on the website and it's also in the Facebook group. Like I said, it's free for right now. When I finally launch it, I'm working through more rough draft versions right now, but it'll be $8 a month. So nothing all that extravagant. So feel free to check that out. And you can access that by joining the private Facebook group. And it's kind of interesting. I've been actually getting some legitimate comments lately, and I really enjoy those little back and forth that we have. But I get a lot of crap comments too, especially from these social media experts that are really just trying to scam you. They tell me how wonderful the videos are. Well, obviously, they don't watch them because I put an email address in there where they can contact me. And instead of doing that, they're just copying and pasting into the comment section. And I do post both on YouTube and Rumble. So if you prefer one platform or the other, you're welcome to use whichever one works best for you. And I also use it as a backup. If one of the platforms is having some difficulty, I will also post to the other platform. And incidentally, with the videos, if you go to the website and become a member, you get immediate access to the videos. Where if you just watch them on YouTube or Rumble, they're delayed. So, and I'll also be rolling out something pretty soon where if you want to have immediate access to the videos without being a member in the program, that'll be like $19 a month or something, where you can get immediate access to the daily videos and weekly videos where I do delay them actually going public. All right, let's go back and talk about the week session. We were down 1% with the S&P. We were above average with volume, so that's been pretty healthy lately. The technicals were still positive with most of our charts here on the weekly side. We're positive on the daily side too, but we're seeing some potential weakness. Now, midway through the week last week, it looked like some weakness was coming in, but then we had a pretty good day on Thursday and it kind of took that weakness away. Well, with the reversal that we saw on Friday, there's some weakness coming back in now. Well, we don't know if things are going to turn negative, but there are some things that are causing some concern. And if we start to see more weakness, that could shift the overall climate to being more negative. And interest rates it looked like we were dealing with that 4.5% level with the 10-year yield. We got close to it on Thursday, close to it on Friday, and then so far that's been acting as a level of support. If we could break down underneath that 4.5% level with the 10-year yield, that might give some support to stocks. But as we're still above that 4.5% level, that's pressuring stocks. And then there's the geopolitical things, which also includes the domestic things that are happening in the US with the executive orders and the tariffs and things like that that are causing some concerns right now. And the market doesn't like uncertainty. So when in doubt, sell. When you're more confident about things, buy. And then we did have the Fed meet this past week. They did not change interest rates, they didn't raise or lower them. The comments that they made really weren't anything that the market didn't really already know. So there wasn't really any surprises there. We are seeing fairly good economic reports coming out. We're seeing employment, at least on a weekly basis, it's still holding up fairly well, and that suggests a stronger economy. We got the latest reading of the GD, or the first reading, I should say, for GDP for the fourth quarter of 2024, and it's not all that strong, but it's still positive. As long as we stay positive with GDP, that means we're not going into a recession. That's just one of the tools that I look at to determine if we're going to go into a recession or not. The markets still are anticipating that we won't, but there's also charts that are giving us some concern, and that can change. And that's why we keep an eye on the recession data that I look at. And then periodically on the website where I have the program, I will update videos kind of on an as needed basis just to say, okay, what's it looking like as far as there being a recession? And I don't post those videos on YouTube or Rumble. They're just on the website. Okay, then as far as our trend, we're still not trending, and we're seeing this on the daily side, both in the short and intermediate term, and we're seeing it in the longer term here on the weekly chart. And that's why we're just bouncing around, not really having all that much conviction. The indicator that we use called the average directional movement or the ADX, it's it's going down, meaning that we're not trending at the current time. We're still positive, both on the daily side and on the weekly side, and I'll show you the chart of that, but we're just floundering at the time, for right now anyway. Okay, so here are some bullet points, and I apologize in advance for this being small, but there's a lot of things happening, and so I got a lot to put on this slide. And if I possibly can, I like to keep it on one slide instead of spreading it out across multiple slides. But let me know if you're having a hard time reading this, just say, okay, it's really difficult to see, and then I'll just easily spread it out over a couple of slides. But the Dow was up for the week, where the S&P was down 1%, the Nasdaq was down 1.6%, and the small caps, which have really been disappointing, they just haven't been performing all that well. They were down 0.9% for the week. Then what happened back on Monday is over the weekend, China came out and said, "Oh, we've got this great new AI model called DeepSeek, and it costs a lot less to put it together. It doesn't need the huge amount of power, computing power that things like Chat GPT need, so it costs less and it does more." Well, the jury's kind of out on whether that's really how it works or not. But that was seen as a real threat, and that produced a gap lower open on Monday, which was kind of disappointing because we were looking pretty positive, and we probably would have been positive, but then this news broke over the weekend, and that produced a gap lower. We were actually, I'll show you the intraday chart. We were actually pretty positive that day if you take the open to the close. It's just the gap lower that we had sucked everything down with it. And on that day, last Monday, Nvidia dropped 17% in one day and bounced back up, then would bounce down, bounce back up. It ended up being down 15.8% on the week. And this is the real darling stock. This is the high flyer, especially if you're in the tech sector more in general and in the semiconductors more particularly. This is the stock that we watch just to see how much of an impact it has on the S&P. Then this past week was a really big week for earnings reports to come out, where about 40% of the market capitalization of the S&P reported this past week. And for the most part, earnings are looking pretty good at this point. They're coming in higher than expected, but not necessarily blowing things out of the water at the same time with their surprises. So companies like Apple, Microsoft, Meta, Tesla, they all reported. And other well-known companies. The first ones are the high flyers and part of the Magnificent Seven stocks or eight or 11 or whatever number you use there. But we also had IBM, Starbucks, Boeing, General Motors, Lockheed Martin. These are big companies and they have a real impact on the overall US economy and the stock market. They all reported earnings this past week. And then on Wednesday, the Fed did meet and they left interest rates the same. We're at 4.25 to 4.5, and that's probably where they're going to stay for right now. And they told us that was what was going to happen. So there was really nothing new there. And then what they do is they put out a statement at the end of this meeting, and they call it a directive. And they still said what they've said before, in that inflation remains somewhat elevated. And that's kind of got the market a little spooked. That's why interest rates are going back up to try to deal with this inflation issue. And they said this last time after the December meeting. But what they didn't say this time was, so it's not what the Fed said, it's what they didn't say. They left it out where they said inflation has made progress towards the committee's 2% objective. They didn't say that this time. And then they also talked about the labor market remaining strong. That just shows the economy's doing well. And that's kind of what we've been waiting to see. Is employment going to fall apart? That's when it looks like we're going into a recession. But we're seeing jobless claims going down. We're seeing continuing claims, for the most part, going down and not being all that elevated. So the employment area is strong. Now, in the upcoming week, on Friday, we're going to get the employment situation report. So we'll see if that changes. So they're just kind of hanging back and just saying, okay, we're not going to raise rates, we're not going to lower rates right now. And then Chair Powell has his press conference after the meeting, and here's a direct quote from him. It says, "With our policy stance significantly less restrictive than it had been," and the market likes that. They want a less restrictive policy. That means they're more dovish. And the market tends to react positively when that happens. And the economy is still strong. We do not need to be in a hurry to adjust our policy stance. We're just going to keep things the same for right now, is kind of what he was leaning at there. And the reports that did come out show that the economy is doing pretty strong. We had the GDP number. We had core PCE come out on Friday, and it's showing that inflation's picking up, but it came in as expected. And then we had this sell-off on Friday because of these tariffs. And it looked like there's no way it's not going to happen. They'll come to some kind of an 11th hour compromise or decision or something. Well, it looks like starting February 1st, which was Saturday, there are going to be 25% tariffs on Canada and Mexico. Now, from the time I'm recording this, the news can change quickly. So this may have adjusted. And there's going to be a 10% tariff on China. Again, switching back to the way the US used to bring in money to the federal government, but it's different than what folks are used to. And the reason for doing this is because of the immigration issues. And that's a large part of why people wanted change in the administration, was lock down the border. And we want to lock down things between Mexico and the US and also deal with what's happening between Canada and the US. And trade deficit as well. It's like we want Americans to have more of an advantage here. So we're going to set things up. So if you're an American company, you get treated better in the US than if you're a foreign company trying to sell products into America. And then fentanyl, the drug issues. There's been a real increase in that coming across the border, specifically from Mexico, that they think comes from China. They want to do something about that. And so putting these tariffs in place is one of the ways that that can be used to stop that from happening. Interest rates also declined. A week ago, we were at 4.63% with the 10-year yield, where we closed it Friday at 4.57%. At the beginning of Friday, we were at that 4.52 and we were going down. On Thursday, we actually opened below 4.5%, but then we came back above it. And So that's right now looking like it's setting up a support level for interest rates. They'll go down to 4.5 and then possibly bounce up off of that. If we can break through that and keep going down, that may end up being more positive. Of course, if they keep going up, that's going to be more negative. So for the week, we had the Dow here up 0.3%. Not much, but it was up. And that largely has to do with earnings reports because there's only 30 stocks in the Dow, and some good earnings reports come out, and that helps the Dow do better. Even though it's not setting an all-time high, the Nasdaq was down 1.6%. We were down 1% with the S&P and down 0.9%, as I said earlier, with the small caps, which have really been kind of a disappointment. On the daily charts, there are two small cap indexes that I follow. One is the S&P 600. The other one is the Russell 2000, which is what you see listed here. Both of them just cannot seem to get above their 50-day moving average, and that's acting as overhead resistance and has been now for a number of days. We're also keeping an eye on inflation. I show this in every weekly video where we're having to see where are we in relation to what's already happened. Now, history doesn't always repeat itself, but sometimes it does rhyme, and that's what they're trying to point out here with this particular chart, where we had been coming down with inflation. That's the light blue line, and things were looking pretty good. And that lines up with what we saw between 1966 and 1982. Well, are we going through a period where inflation is starting to go up? Are things going to develop within the economy where we hit super, super high inflation like we did back in the mid to late 70s? We don't know if it's going to actually unfold that way, but we're seeing a parallel between what was going on between 1966 and up to about 1976 or 1977, and then what can happen after that. And I've been showing this chart for about a year and a half now, and I update it when there are versions of this chart available. So we just want to keep an eye on this. This is also a chart I've been showing for a long time, a while back, RenMac, and I found this chart on Twitter, gosh, year and a half ago, where they came out with some research that said when the 10-year yield gets above 4.02%, that's when it starts having a negative impact on corporate earnings. Well, we're at 4.57% right now, so we're above that level. This will be updated next week. This is long-term unemployment, where it was starting to pick up in the latest reading. We'll watch to see in the upcoming week if this is adjusted either to continue to go up or actually start coming down. This is showing that earnings looking out into the future, because that's what the market uses. They look forward, they look at forward um, projections and forecasts. And if they're continuing to go up, then okay, the stock market's happy and they're willing to have stock prices go up, even if they're considered to be expensive. Well, it's a little hard to see here, but we're going up and to the right, and that's the big takeaway. But we're seeing these numbers coming down. They're not as high as they were previously, but you would only know that from looking at previous charts here. All right, and this is kind of a whole mishmash of different data that says that a good start to 2025 could be positive for the year. And we do have historical data that shows us that if January does well, the rest of the year tends to do well about, I think it's 86% of the time. If January is up, then the market ends up being up. And so they went all the way back to 1951 here, and we look at the average return. Here it says it's 84.4% of the time. And then for the whole year, if you're including January and then the next 11 months after that, we're up 87.5% of the time. There's a different company that puts out a book called the Stock Traders Almanac, and they also show the same basic conclusion that we're seeing here, but their numbers may be a little bit different. So we're looking at anywhere from an average return to a median return of between 12 and 13%, where for the whole year, we're looking at 18 to 19% for the return. And then you compare that to just an average year where we're typically up 9.7% or just a little over 8%, and we're higher 76% of the time. Where if January is positive, we're up 84, And we're up 72% of the time, including January, where we're up 87.5% of the time otherwise. Okay, and this is looking at heavy truck sales. Seeing a bit of a disconnect here where we've been going up with the S&P, but we're seeing sales actually dropping off a bit here. And I don't know, are they delivering things by drones now? Is that why there aren't as many trucks being purchased at the present time? And this is a variation of the chart that we seem to show quite often. The market cap of the seven largest S&P 500 companies as a share of the total index, and that's why we watch them. And I actually bring up charts of these seven stocks, and then I think I include another chart or two to make it eight or nine. But it's 33% of the overall S&P 500 as far as the market cap. And so when they're having a good day, the S&P goes up. If they're having a bad day, then the S&P is going down. So that's why we keep an eye on them. And then the dominance of the biggest companies in the US, it's a function of the vastly superior earnings power over the past decade. That's why they're the Magnificent Seven. Their stock price is going up because their earnings are going up, and they're really outpacing what we see with the S&P itself. And then the we're seeing money coming out of Bitcoin. It got above that 100,000 level and it's just kind of camped there. We get a little bit above it, then a little bit below it, and we're just kind of trailing along. We're not really seeing much of a trend these days, even in Bitcoin. And then while technology grabs much of the headlines over the past couple of years, US technology has actually outperformed together with European banks. Now, I showed a chart earlier in the week that compares the Magnificent Seven in the US with, I forget what it's called, it's an acronym, but it's the high flying tech stocks in Europe. And they are really underperforming. The European stocks are when compared to the US stocks. But if you want to see something that's performing more in hand, you would look at the European banks, and they tend to actually be performing quite well. All right, then earnings update here as presented by FactSet. They had a couple of different blog posts. This was as of the 27th, where it says the reporting that's coming out for the S&P. It's 12% above the third quarter as far as when you're looking at their profit margin. And it's down from other readings that we had, but we're still looking pretty solid here. And then the earnings update as of Friday, 36% of the companies in the S&P recorded, and of those 36%, 77% of those 36% are coming in above their estimates. Now, when you take it all together, and there's still a lot of companies that haven't reported in the S&P, we're 5% above the estimates, which is the takeaway is below average. So we're showing that they're growing, but not growing as much as they have in the past as far as their earnings. All right, here's the intraday chart going back to Monday, and this was the big gap down that we saw. We were looking pretty good after the previous Friday, and things were positive. But then we had this news breakout over the weekend that the market didn't get a chance to react to until Monday. And most of the loss was seen from the gap. You can see here, after we opened, we actually held on. We didn't continue just tanking down. And from an intraday basis, we ended up closing at the high for the session. That's this last green bar. This is a 10-minute intraday candlestick chart that I look at, and I follow this, even though I don't day trade. This gives me a good idea of what's actually happening in the market. We can see, is there late day buying? Is there late day selling? Are we seeing the smart money coming in and doing anything? And then it looked like things were turning more positive here. We were recovering and trying to get back some of these losses, which by Friday we actually had recouped this gap. It's just things fell apart on Friday when the whole tariff thing came out, but that's not really a surprise to the market. This has been announced for quite a while. The market just said, well, maybe something will be done and they won't end up happening because that's usually what politicians do. They come out and they say, well, if we don't do this by this date, it's the end of the world. And then at the 11th hour, they come to some kind of an agreement and it's averted and the market likes that. Well, it doesn't look like it's being averted right now. But then in Tuesday's session, we saw some pretty good strength. Not a heavy trend here, but we were really going up higher. Then Wednesday, this is when the Fed met. And so we kind of chopped along. Things were pretty quiet. We actually saw a little bit of negative bias right after the Fed came out with their announcement. But then during the press conference, we bounced right back up. Then on Thursday, we had a higher open, but then we gave a lot of that back. And again, it looked like we were getting pretty solid here. We see a lot of green bars coming in, but then there was some tariff talk right here that drove things down, but then we bounced back up going into the close. Then things were looking pretty good for Friday. We gapped higher, went up, hit this R2 level. And that's why I talk about these pivot points. They're on the website every day. And these R2, R1 levels, S1, S2 levels, we know these before that particular day. So we know this ahead of time, and we can be watching these areas of the market. Well, we topped out right there and just started to drift. And then this is when the tariff fear started to come into the market and gave up a lot of gains, but we also found some support down at another S1 level. So these are pretty useful tools. And with any technical analysis software that you use, you might have that where they're built in. All you have to do is select that, and the computer will automatically draw these pivot levels on there for you. So looking at the different indexes for the week, we had the Dow actually being down a little bit. Now, this is just the 5 trading days. But if you go from Friday to Friday, the Dow was up. But if you go Monday through Friday, the Dow ended up being down, as were the small caps, virtually unchanged with the mid caps. And the NYSE, that's a broader market measure. It was up slightly where we had the S&P, the NASDAQ, and the NASDAQ 100, even though they were down on the week. Again, I purposely look at this in a different way, not on a Friday to Friday basis, but a Monday through Friday basis, just to give us more of a look at the action within that particular week. But when we go back to the beginning of 2025, all of the indexes are higher, which we just ended January. So we had a positive January for the S&P, which on a percentage basis tends to show that 2025, we don't know what kind of returns there will be, but that we have the odds that it will end up being an up year. But over the last, going back to the beginning of the year, the NYSE is doing well, and that's encouraging. That's a broad market measure, and so to see that doing well and performing the best right now is encouraging. And then we have the Dow, the mid caps, small caps, the S&P. And then what's lagging right now is tech, the NASDAQ 100, and then the NASDAQ itself. So not a real strong market when you look at it this way, but we're still positive nonetheless as we finish out the month of January. And then this goes over the last week, looking at the 11 sectors that make up the S&P. And some of these sectors are more growth oriented, some are more defensive, some are driven more by what's happening in the economy. Well, since we had a down week, I arranged that showing, okay, what was down the most? Energy did not have a good week. And tech, that's a growth area. It ended up being down. Utilities ended up being weaker. And then you can make a case that, okay, are utilities more defensive? Well, with all the crypto mining and switch to EVs and AI, I ain't throwing acronyms at you like crazy, but could utilities actually end up being a growth area because we're going to need so much electricity to generate what's needed for all this technology to actually happen? Well, it still was down on the week. The industrials, real estate, and the areas that ended up being positive are more encouraging. The growth areas, communication, that's a growth area. Um, the financial sector was up, and that we want the banks and the whole financial sector to do well. Discretionary is another area that's growth. And then you have tech up here, which ended up getting hit. And that's the NASDAQ 100 and the NASDAQ. The NASDAQ 100 stocks are also in the S&P 500. So that's why the S&P languished. Then this looks at a different way of sorting this, where we rank the particular sector on a scale of 0 to 100. The higher the score, the better looking that particular sector. And we still have discretionary and communication looking the best. They're into the 90s. And this tries to remove all emotion. It tries to just look at different technical analysis indicators and puts them together and then comes up with a score. We're also into the 90s with the financial sector. So this is still pretty solid. The one area that's been a bit of a disappointment is the tech sector. That's the big growth area, and it's languishing a little bit now, just a little bit over 50. And then if you look at materials and energy, those are the weaker areas of the market based on this scoring method. So looking at the sectors just for the week, we had communication and tech. They were up slightly. Discretionary was down a little bit, and then all the rest of the sectors ended up being down. Beginning of the year, we're actually seeing healthcare, which is defensive because you have to have healthcare no matter what's going on in the economy. We like that the financials are performing well so far in 2025. Communication, that's a growth area. Then we get into some more economically sensitive areas. We're way over on the right-hand side. This has been discouraging. We have tech actually performing the worst so far in 2025 on a sector basis. Then another way of looking at this is going back over the last year, and we see, okay, where's the rotation going here as far as what's showing some weakness, what's showing some strength. And if you look at XLY, which is discretionary, this is probably the strongest area of the market. But the fact that this is rolling over here is showing some weakness. And then XLC is communication. That's all and these are both growth areas, so that's positive. But then we see a lot of weakening areas here. But one thing that is encouraging is this blue line here. That's XLK, which is tech. That's improving for right now. It's not getting into the leading area. It's lagging right now. Now, this is a little bit different than what we just saw because the previous charts are based on what happened during the week. This is basing things around on what has happened over the last year. And then this is presenting that same information in a little different way, or we're still looking good with computer or communication and discretionary, and those are growth areas. Financial sector a little more neutral right now, but still holding up fairly well. And then we have the more negative areas here in red, and an improving area would be tech. So again, looking longer term, the growth areas are still holding up fairly well, improving when it's blue, actually more positive when it's green. And we just look at the main indexes here, and we were seeing a real jumble right around the middle here. Now, over the last year, we've been seeing a bit of a breakout as the NASDAQ 100 and the S&P 100 have been performing better, and the other indexes are actually showing some weakness. And we keep watching this just to see if we're seeing longer term rotation from one area of the market to more growth, which means it's the anticipation is that it's more positive. Or if we're going over to value or we're getting more defensive, that tends to be more negative for the market. And then here's another look at that where we have the big indexes, the S&P 100 and the NASDAQ 100, they're looking the best. With the S&P blue, it's showing some improvement here, and then the other indexes have been under pressure lately. Then we keep an eye on sentiment using a number of different tools to do this. We get a weekly report on investors' intelligence coming in at 1.6. We really pay attention to this if we get above 3 or below 1. We're in between that right now. So not giving us any kind of an extreme reading. We're coming back up to neutral when we look at the fear and greed index, and this is something that I follow every day. There's also other sentiment gauges that I look at each day, and then other longer term ones that I usually only look at every week. But we're coming in neutral at 46. Now, to give that some context, we were coming down into the 20s. We were actually negative, and we have been showing an improvement here overall. We were going up, but over the last couple of sessions, we've been ticking back down. We tend to roll with this in whatever direction it's going, and so this has been more positive. It would turn even more positive if we could get back above 50 and this could continue to go up. Active asset managers, not really extreme one way or the other with the latest reading. So when we get above this red line, this is when we use it as a contrarian indicator to look at the market showing some weakness. And if we get down below this blue line, That's where things have become very weak, and we're looking for things to possibly improve. And this is that same thing, but now they've kind of rearranged with how this is presented here, coming in at 68.28 and not an extreme either positive or negative reading right now. We did tick up a little bit here with the VIX, but the takeaway with Friday's decline, we didn't see the VIX move all that much. And we're still below 20. It's when we get above 20, that's when things are turning more negative, according to the VIX. But we did go back up a little bit here, both with the line chart and the bar chart. You can see in Monday's session, we got above 20. We opened above 20, but then we came down from that 20 level. This is still positive. When the black line's going down, that means the tech sector is outperforming cash. And so this is not really showing any weakness currently. Then this is another sentiment gauge. Ridex has both bearish and bullish mutual funds that you can get into. So if you think the market's going up, you get into a bullish fund. If you think the market's going down, you get into a bearish fund. There's a 1 day lag with this chart, so this is after Thursday, and when we get a low reading here, that means the folks are pretty positive on things. Now, in the next reading we get, it's probably going to really spike up because that decline that we saw on Friday probably freaked out a lot of people. But that's not being picked up in this latest reading. We every week get the individual investor survey, which is an actual organization. And we did see a bit of an improvement here. We're above zero with how they're feeling. They're not extreme positive or negative now, but it's turning a little more negative because we're seeing the 50-week moving average continuing to go down. And this means on a trending basis, individual investors aren't as positive as they had been. We're still below another sentiment gauge here, the moving average called the Ulcer Index, where we're starting to drop down below the moving average on the daily chart. And we're keeping an eye between risky and not as risky bonds. And I've been showing this for a while. Look at this similar to how you would see the VIX. When we're really going down with the market, this tends to really spike up. And this we're getting a very low reading here. But other times when we get to a really low reading, that means, okay, there's not much more optimism that can come into the market now. And that means this might start going back up because the market is actually going down. This is that same thing, but then inverted. And the focus here is the middle area. It's to line up with the S&P and the VIX. We ticked up a little bit here, meaning fear increased slightly because this came down on the inverted version of the chart. But we're still seeing very low readings overall, showing there's not a lot of fear in the bond market. In the bear market, I don't know. If you drink enough beer, the fear seems to go away. Then we look at the VIX and then take a 3-month average of the VIX and do a ratio. Chopping around right now. We're not really seeing a lot of conviction. We're still going down when we look at the 253 period moving average of the equity put call ratio. That's more positive. When this is going down, the market's usually going up. When this is really going up, like it was in 2022, the market's usually going down. Looking at the economy, no concerns here. We have the latest reading of the National Financial Conditions Index. We're below the black line, and that just means we're doing okay. If we get above the black line, that's when we start to get concerned. And then we have a couple of different readings here on what's called the GDP Now. It's a forecasting tool put out by the Federal Reserve. Is it Atlanta? Yeah, in Atlanta. And this is looking at what did they think was going to happen for the fourth quarter GDP. And we were coming in up over 3%, with the forecast being at 2.5 to the upside to about 1.75 on the downside. And then now we're starting to look out and get forecasting for the first quarter of 2025. And we're coming in just under 3% right now, with the forecast being about 2.5% to the upside and a little over 2.5% to the downside. But this will adjust and work its way out as we go through the first quarter of 2025. This is also showing that same thing, but now projecting out what they think GDP will be, where we're starting to get the real numbers for what the fourth quarter of GDP is for 2024. The takeaway here is that these are still positive. This will be updated in a week when we get the next employment situation report. That just shows what's the recession indicator looking like. We're still below the red line. If we go above the red line, then that creates a bit of a concern for us. And the reason I have the zero point 0.4 here is because the red line's at 0.5. So that's why we'll be watching that. And then the US recession probabilities, we are coming in above the black line. We really get concerned if we go up above the red line. This is a quarterly report, also a leading index, which in the latest reading actually had us declining. And then inflation now, this is similar to GDP now. This is an attempt to forecast what's happening as far as inflation. We did get core PCE that came out on Friday, and that pushed these numbers down a little bit, where we're getting the CPI numbers still coming in a bit more flat. All right, and then now we're done with the January meeting. So now we're going to start focusing on the March 19th meeting. And there's an 83% chance that they'll leave rates the same at that meeting. And we're kind of locking that in more now. And how this reads is the blue, that's current. And then we look back a day before, and then we go back a week, and then we go back a month. And it's getting more locked in that they're probably going to keep rates the same, but we still have a ways to go to get to March 19th. So this changes every day. I just show these charts in the weekly video. And now we're looking at the May 7th meeting, where a little bit more of a lean in the direction that they're going to keep rates the same at that meeting as well. And it shows how this is locking in more. More folks are kind of focusing because the Fed said that we're pausing rates for right now, and we're increasing our inflation outlook. And so that's why the market is focusing more on that level, which would be the same as where interest rates are at now. This is just a look at the Fed balance sheet, which is showing a decline. And then we look at it on a year over year basis, also showing a decline. We keep an eye on this. This is showing when we get very low readings that this could be okay. There's a lot of complacency right now. It's called the overnight reverse repurchase agreements. And we're just looking for big spikes or moves back up right now. And we're not seeing them, even though it did tick up a little bit in the latest reading. Then we get into our charts here. Now, we're still looking positive on the daily charts when we look at the advanced decline line based on price and volume. And we're looking positive here too. So that's more positive confirmation. We're also positive when we look internally at the new highs minus the new lows. We're going up on the daily chart. We're going up here with the 4-week moving average and up with the 10-week moving average. Seeing a bit of a decline here, just a little bit negative with the short-term advanced decline ratio. This has been trailing off a little bit as we've been hitting high readings going back to October of 2024. This could suggest that at least there's some weakness or a lack of strength coming in longer term right now, but not necessarily turning over and looking drastically negative. This is where I show that we're not trending right now on the weekly charts, and we're still going down with the ADX, and we're below the moving average. We're positive though because the green line is on top of the red line, but we're a little bit concerned because the green line's going down as the red line's going up. But we're still positive here. And we're still positive on the daily charts too. We're just not trending. This is another attempt to match up buyers versus sellers. We're getting a high reading here with the Erin indicator. We're also above zero on the daily charts. The mass index, not seeing a trigger here longer term on the weekly chart. We are seeing the criteria was met on the daily side because we have to go above the red dash line, then the blue line, and then cross back down below the red dash line again. That happened on the daily chart, and that may be, it's just one of the areas that we're watching because it may be signaling a reversal could be happening. And here's a daily chart where we're still well above the 50-day moving average. This is a little bit hard to read. This is what I post on the YouTube community tab are these pivot points, and then it's a shorter term chart, and I just update it with that day's bar. And not really much of anything here with our pivot points. These are longer term, and these last for the whole quarter. That's why I don't post this on the YouTube community tab because it's a much longer term chart. This is a concern, and I've been bringing this up in the daily videos. We're still coming up to the upper end of this trend channel. Is that providing overhead resistance? So far, the answer is yes. We've not been able to break above this. But on a trending basis, we're still looking good. We have a 50-week moving average here that's in red and it's going up, and price is above the red line, and both are going up right now. Then I use a moving average crossover system here. We're still above the 13-week moving average with the S&P and showing a little bit of a drop off with the McClellan oscillator, but we're still above zero here. A little bit of weakness that this is picking up, but we're looking good with the summation index based on price and volume. We're crossing back above zero. So that's a little bit longer term positive. Coming down, but still positive with the Swenlin trading oscillator based on price. And we're dropping below zero now based on volume. And a week ago, the daily chart started to roll over and it spent all last week going down. It tried to turn up with price on Thursday, but after Friday's decline, it's now going back down. And we never did turn positive on the volume side of that chart. Little bit of a concern here that we've been watching, both on this chart because we're coming down and we're actually negative on the daily chart as well. The bullish percent index, this actually has held up fairly well, even with the down day that we saw on Friday. We didn't see much of a deterioration here. So we're above 50 and going up. That's positive. And then we look at the momentum where we're looking negative with the PMO. We saw an improvement based on price and volume, but we're still below the moving average with the indicator itself. We had become extreme positive with the PMOs that were rising, but now we're dropping off of that. We had become extreme positive with the buy signals. Now that's starting to come back down, but the PMOs above zero continues to go up. This is smart money indicator number one. We're still looking good here on the weekly side, where we're positive on the daily side, but now we're rolling over and starting to come back down. Another smart money indicator where we're still positive here. We're kind of going sideways with the red line, where we're starting to decline now on the daily charts. And this, after giving us a really extreme positive reading, this is our smart money indicator number three. We came up to this red line and now it's rolling over and actually turning negative because it's below its moving average. The force index did decline, but we're still positive there. No real changes with the percent B indicator here. This just measures if we close above or below the upper or lower Bollinger Band up here on top, and we didn't. Momentum is looking more negative in the short term, looking more negative in the intermediate term, and even the long term, where we're still positive across the board on the daily side. We're below 50 with the money flow, so this is turning more negative. And we had a down week, so we dropped below zero with the week over week change. Then we look at another week over week change going back 50 weeks. We're still above this red line here. So even though it's been seeing some weakness, it's holding up for right now. We declined, but still above 50 with our long-term RSI. And the Stoke RSI had crossed above the midpoint. Now it's starting to cross down below it and not showing any longer term momentum. When we get really positive with the market, we tend to camp up at these high levels. Just like if we're going down, we tend to camp at these lower levels. We're slightly negative here because we're below the midpoint. Ultimate oscillator still above 50. That's positive. Coming down, but still just barely extreme positive with the Williams percent R. And you can see for most of 2024, we were up in this really strong momentum area as the S&P was really doing well. The vortex is positive not only here on the weekly chart, but it's positive on the daily chart. I consider this to be another primary indicator. It's one of the ones that I consider to be more important. And this is longer term positive. We're still above this red line with the special K. And we're also positive on the daily chart. But momentum is more negative here. This is similar to the oscillators that we use. This is another momentum oscillator called the Koppel curve. It continues to decline. And we're still above this 10-week moving average here. Even though we opened down below it on Monday, we were able to get back above it during the week. So this support level is continuing to hold for the time being. So we're still looking good here on the weekly side with our Heiken Ashi chart, and we're positive on the daily side. We're positive here with the Keiki chart, but we're pointing down. It's positive when it's black, but pointing down is causing a little bit of a concern there. We're positive with the Renko chart, and we're positive with the three-line break chart. So longer term, we by measuring the trend in different ways, it's pretty much positive here. And then another thing is we look at the ease of movement. We're still above a 14-week version of that. And we're coming back after being negative on the daily side and crossing back above zero with the daily chart. No new X's or O's were drawn this past week because we've been just chopping around. And momentum is leveling out longer term. It's also leveling out intermediate term, but in the short term, we are seeing some weakness here. And we're still positive though with the Elder's Impulse system for the S&P. We've had 3 green bars now over the last 3 weeks. And for the second week now, we're still positive with the parabolic SAR, and we're also positive on the daily side. Then when you look at this in the short, intermediate, and long term, and these are based off of daily charts, we're positive across the board with all the different indexes that we look at. We're negative across the board with bonds based on price. We're negative with the dollar in the short term. Everything else is positive. And then we look at just the main indexes here. The S&P cannot, this is the double top I'm talking about here. Are we going to come back down from this level, or are we going to break up and go back and set a new all-time high and then keep going? But we're holding up pretty well with the S&P. We're seeing a bit of a negative divergence here, both with the mid caps and the small caps, as they both have been underperforming the larger caps, which is the S&P. So we look at a crossover system here with the Dow, not at an all-time high yet, but still above its 13-week moving average. We're positive with the NASDAQ, positive with the NASDAQ 100, and right at this 13-week moving average with the mid caps, and a little bit below this 13-week moving average with the small caps, as they've been just chopping sideways for the last few weeks. The NYSE, a broad market measure, is above its 13-week moving average. This is a daily chart of the Wilshire, still above its 50-day moving average. All stocks, which uses US and international stocks, declined this past week, but still looking really solid from a trend perspective longer term. The FANG index is still above its 50-day moving average longer term here on the weekly side. ARC ended up being up 0.87% for the week. It's in an uptrend and above its 13-week moving average. The banks are holding up fairly well here, looking good with the RSI above 50 and continuing to go up. Price is looking pretty good, but we're not back to these previous highs set at the end of 2021 going into 2022. And the momentum had turned more negative. Now it's trying to turn back more positive. Adjustments here to the seasonality chart. We finish now with January, and we're up 60% of the time with a return of 0.8%. Now, this is including 2025, so that's in this calculation now. We switch over and now look at February, which it's a coin toss, 50-50, up or down, with about a 0.5% return going over the last 5 years. Then we look at just a plain vanilla chart of Dow theory, which we have the Dow not there yet, but coming back to the all-time high, seeing a negative divergence here. The transports are not performing well, and the utilities are also not performing all that well. So the premise behind Dow theory is if we're at or near a new all-time high with the Dow, we should be with the transports. And then I also include utilities into that mix, and we're not back to an all-time high, at least yet. Looking at commodities, we are in an uptrend here on the weekly chart. Oil has been coming back down into the lower 70s range because, I think it was right after the inauguration, President Trump came out and said, well, I'm just going to tell OPEC and Saudi Arabia to make their oil prices go down. And they did, at least for right now. We'll see if that's actually going to be longer term or not. The dollar is still in an uptrend the way I measure it here on the weekly chart. We're still above this 13-week moving average. Copper still in an uptrend longer term. That shows confidence in the economy going forward. And we have been seeing some fairly strong economic reports, and that justifies copper still going up. Gold is coming out now, setting a new all-time high. Silver not at an all-time high, but still in an uptrend and breaking above its 13-week moving average. And we keep an eye on interest rates. I was really honing in on this for a while, where with the total bond ETF, now, this is a little bit different. I was watching a daily chart here, where this is a weekly chart, where I was watching the 200-day moving average. That equates to a 50-week moving average, roughly there. And we're still above this support level longer term. And this just shows that stocks are really outperforming bonds. And that is not necessarily causing a concern like going into this is the dot-com boom and bust. If we really start to see this go down, the market's in trouble. And then we had the great financial crisis where it went down here. Well, going back to after the COVID crash, stocks are just really continuing to outperform bonds on a monthly chart. That's long term. We are keeping an eye on interest rates. It would really help things if things continued to decline there and get under that 4.5% level with the 10 year. We're watching the 10 year in Japan too. If that keeps going up, that might cause a problem similar to what we saw last summer, where we got above 1%. That was freaking out folks in Japan, and that sent a shock wave through the whole world that lasted a couple of days. And now I've changed this over the intermarket analysis chart going back to the beginning of 2025 because now we've completed our first month here, where so far gold is doing the best on a return basis, followed by oil stocks. The dollar is positive, and we're just slightly negative here with bonds based on price. This is the TLT, which is the long-term bond ETF. And we're still looking pretty good here with the NASDAQ to S&P ratio. Saw some weakness, but still longer term looking positive. The S&P 100 is continuing to outperform the rest of the S&P 500. So that means the large caps are outperforming the smaller stocks, which are also really big companies, but not as big as the really big companies. Growth to value ratio still looking good longer term. That's positive. Pretty much chopping sideways when we look at a gold to S&P ratio and showing here where gold is starting to outperform the dollar. The dollar has been seeing some recent weakness. Gold is going back and setting a new all-time high, so that's when we see this ratio going up. Bonds continue to underperform stocks. Discretionary continues to outperform staples. That's positive. And we're still showing a real underperformance here, longer term on a weekly chart. The low volatility stocks or the defensive stocks, or you can see how they did in 2022. Those were the better performing areas, and that's when the market was going down. Well, this just continues to show that the low volatility stocks are underperforming the S&P. Energy continues to underperform the tech sector longer term. Small caps continue to underperform the tech sector longer term as well. And then some long-term looks here. Not much of a change with the ZWAG NYC breadth thrust. We got a spike above this red line, but it didn't come fast enough here. So we're not really getting much insight from this chart right now. Longer term, going back to the 1987 crash, the S&P weekly chart is still positive. This is a further breakout of that same trend. We're still comfortably above that trend line. We're still producing a full-on buy signal with the Zahorchak method. Looking at the NASDAQ 100, we're still above this longer-term trend line going back to 2009. And we're improving here with the 50-period new highs, new lows for the NYSE. That's showing internal strength starting to improve, and we're still above zero. Then we look at this based on the S&P 500, also turning back up and still above zero. Then we do a ratio between growth, which is the NASDAQ 100, and the Dow, which is considered to be more value. We're still holding up with this overall ratio. And we look at the Qs, the NASDAQ 100 to small caps, still showing that the NASDAQ 100 is outperforming. And we keep an eye on the 3-month yield, not seeing any real concerns right now, even though the rate has been coming down. It's not crashing down like it was in 2007 going into 2008. And that's why we also keep an eye on the financial sector. And we're still looking pretty good here with our cumulative new highs and new lows for the NASDAQ. That's longer term positive. And then seasonality, we're coming into February now, where the return's 0% and we're up about 50% of the time. Not a real gangbuster of a month, but it doesn't mean that it's going to be negative. It could end up being positive, but this is just looking statistically going back to 1964. How does February perform? This looks at the period from November to April, which tends to be the strongest period of time for stocks. And we do have a return, an average return of 7.1%, and we're up 77% of the time during this window that we're in now. It's 6-month returns. Now we're focusing more on February, where the first half does okay. It's in the second half of February where we often see weakness going back to 1950. Doesn't mean it's going to play out that way. That's just statistically and historically what has happened. This is looking at the whole quarter, where the first quarter, after we start the new cycle with the new president, not much of a solid return there for the whole quarter. This is for looking out for the whole year. It also is updated here. We're done focusing on January. Now we're coming into February. And this tries to take, okay, what are the different ways that we can look at a post-election year? And these different lines just show you what the performance was based on what they're looking at here. This is another thing put out by Carson, where quite often the first half of February tends to be positive. It's the second half of February where things seem to be weaker. We'll see if it plays out this time in 2025. Then here, we're no real advantage during a post-election year going back to 1950. We're up 9 out of 18 times. We're down 9 out of 18 times. So you can flip a coin there, but the return ends up being negative for February. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.